So you may have heard of it previously. Or maybe it just seemed like another government mumbo-jumbo plan that doesn't concern you. But what are registered retirement savings plans really all about? Well, an RRSP is actually a special type of account that is registered with the Canada Revenue Agency. And here's the deal. When you put funds into that account, you immediately enter into an agreement with CRA that has three main benefits. First, you will get a tax deduction for the year in which you deposit money into your RRSP. Any investment gains in that account will not be taxed when they are earned. And you will be taxed only when you take money out of that account at your marginal tax rate. Using an RRSP to save your money has very valuable benefits. You not only get to save on taxes for the year, the growth in your account is not taxed as it is earned, and you only pay taxes when you withdraw money. For example, let's say young Bob here is in the 40% tax bracket between federal and provincial taxes. A $10,000 RRSP contribution saves him $4,000 in taxes for that year. That is $4,000 he would have paid to the CRA and been miserable thinking of having only $6,000 left in his account. Fast forward in time, and old man Bob has a much lower tax rate upon withdrawal because his marginal tax rate is lower after retirement compared to when he was actively earning income. A benefit of a spousal RRSP is that some of Bob's contributions can be put into lovely wife Amy's name so that the income can be split during retirement and provide additional tax savings for them. Let's look at the difference between the amounts accumulated by two different investors. At the beginning of each year, both contributed $10,000, one into an RRSP and the other into a non-registered savings account. Both investors have a marginal tax rate of 40%. Do you notice how the contributor to the RRSP pays no initial tax, and so the full amount is available to grow? The contributor to the non-registered account has to pay $4,000 in tax each year, and therefore has just $6,000 available to invest. Even the earnings on that $6,000 investment also get taxed each year. And even if Bob, after 30 years, decides to cash out and pay the highest marginal tax rate of 50% upon withdrawal of the full amount, he would still end up with over $200,000 more than the non-registered investor. Many retired people will plan to live off the income that their savings will generate and try not to tap into the principal too much. While all of this interest is taxable, the RRSP will generate more than 3 times as much income as the non-registered savings plan. Choosing an RRSP over a non-registered account actually helps you to achieve massive savings and more retirement income.